Hello, Chartered. Good noon, everybody. I welcome you on behalf of JK Shah classes for this online revision for CA Foundation examination for all India, completely complimentary. I hope it benefits us. It benefits you all rather, and you can perform in the examination in the best possible fashion and pass out with flying colors. Now we are supposed to start with fresh chapters. We had done sale on approval, bills of exchange, rectification of errors, depreciation. Today we'll do inventory, average due date, and account current. So let's start with our first discussion, that is inventory valuation. In inventory valuation, first let us understand what we are supposed to study. In inventory valuation, we are supposed to study what is inventory, why inventory valuation, how to value inventory, principles of inventory valuation, techniques of inventory valuation, and accounting for inventory valuation. I repeat, what is inventory, why inventory valuation, third is how to value inventory. In how to value inventory, we've got two parts: principles of inventory valuation, techniques of inventory valuation. And thereafter, we are supposed to study accounting for inventory valuation, that is periodic and perpetual. So, Chartered, what is inventory? As soon as we hear the word inventory, it strikes us, it is stock. Stock means stock of goods in which we are trading. Stock is divided into three categories: raw material, work in progress, and finished goods. Raw material, work in progress, and finished goods. Cloth is a raw material. Shirt without buttons and collar is work in progress. That is semi-processed goods, the goods which are incomplete, which will get completed after further production process. And the last is finished goods. Finished goods means goods ready for sale. That is shirts ready for sale. So cloth is my raw material. Shirt without buttons and collar, incomplete or work in progress. Third, shirts complete, ready to wear and ready to sell is known as finished goods. So this is the meaning of inventory. Second, Chartered, why inventory valuation? Now, inventory, that is a stock, you must have seen in final account, it comes in trading account credit side. If it comes in trading account credit side, and trading account gives us gross profit, that means incorrect inventory valuation, that means incorrect closing stock value will give us incorrect profit. That means, can I conclude that inventory valuation helps us to give correct profit? Yes, no? Yes, sir. Secondly, inventory, that is closing stock, comes in balance sheet asset side also under the head current assets Chartered. Fair enough. If inventory comes in balance sheet asset side, and balance sheet gives us financial position of the organization, then if inventory valuation is incorrect, then the financial position as depicted by the balance sheet would be incorrect. Therefore, inventory valuation becomes important for two reasons. It helps us to find out correct profit, and second, it helps us to find out correct financial position. Am I clear? Third, how to value inventory. Correct. So first, let's start writing few things and then we move how to value inventory. Now, Chartered. So let's start writing. Name of the chapter, that is inventory valuation. Inventory valuation mein, I said, point number 1 is introduction, in which we are supposed to discuss 1, 2, 3. First is what is inventory. Second, why inventory valuation. And third chartered is how to value inventory. What is inventory? I told you inventory is one, A, raw material, B, work in progress, that is semi-finished goods or incomplete units which will get completed with further production process. Third is finished goods. Finished goods, that means goods ready for sale. Then we have got Y inventory valuation. Y inventory valuation, I told you inventory, that is stock, comes in trading account. So if inventory valuation is incorrect, our profit will be incorrect. Yes. So A, for profit, and inventory as a stock comes in balance sheets of our correct, incorrect, inventory comes in balance sheet. Therefore, incorrect valuation of inventory would affect our financial position. So it helps us to find out correct financial position. How to value inventory dealt later. Now charted this profit. How inventory affects profit? Understand. Inventory comes in trading account as opening stock, closing stock. Opening stock means last year's inventory which is unused, unconsumed or unsold, which will be used in the current year. That is inventory balance at the beginning of the year, and closing stock means inventory balance at the end of the year of raw material, finished goods and work in progress. Now charted inventory comes in as opening stock on trading account debit side. Trading account debit side represents expense side. Yes, sir. Opening stock comes in trading account debit side, and trading account debit side represents expense side. Yes. So if opening stock is wrongly overvalued, that means expense is wrongly overvalued. If chartered expense is overvalued, that means expense is increasing. Profit will decrease. Yes or no? Yes, sir. If opening stock, which is on the expense side, is wrongly overvalued, so opening stock increases, expenses increases, profit decreases. Therefore, opening stock increases, profit decreases. And vice versa is also true, chartered. Opening stock if decreases, that means expense decreases. Expense decreases, then profit increases. So if opening stock decreases, profit increases. That means, can we conclude that opening stock and profit are inversely proportional to each other? Yes, sir. So we can write opening stock increases, profit decreases. Opening stock decreases, profit increases. This is a symbol of pi. Pi means profit. This symbol which you can see is of pi, and pi means profit. Now charted. So opening stock is inversely proportional to profit. Opening stock increases, profit decreases. Opening stock decreases, profit increases. Correct? Similarly charted, closing stock comes in trading account credit side, and trading account credit side basically represents income. Fair enough. So if closing stock increases, income side increases, profit also increases. So can I say if closing stock increases, income increases, profit increases. Closing stock is wrongly decreased, income will be decreased, profit will also be decreased. Therefore, chartered, can I conclude? Closing stock is directly proportional to profit. That means we can say closing stock increases, profit increases, closing stock decreases, profit decreases. This profit is pi. So this is the relation of stock. This is the relation of stock with profit. So what is inventory? Raw material, work in progress, finished goods. If you pick up shoes, leather and sole is raw material. Shoes without sole or lace is work in progress, semi-processed goods or incomplete goods. Shoes ready to sell, ready to wear is finished goods. Am I clear, chartered? Yes. Now, chartered, inventory valuation is governed by accounting standard 2. Correct? Now, let's jump into point number 2. What is point number 2? Point number 2, chartered, is how to value inventory. How to value inventory. For inventory valuation, chartered, there are 2 things which we need to learn. First is chartered, principles. Principles of inventory valuation. And second is techniques of inventory valuation. Correct? So principles of inventory valuation, techniques of inventory valuation. So obviously in your mind there is a doubt now. Sir, what is this principles of inventory valuation? And sir, what is this techniques of inventory valuation? No problem, chartered. Now let's start with principles of inventory valuation. Now, chartered. Inventories of how many varieties? 3. What are those 3 varieties? Raw material, work in progress, finished goods. What are the 3 varieties? Raw material, work in progress, finished goods. So let's see how inventory governs the valuation of all 3. That is raw material, work in progress, and finished goods. So first, raw material. Second, work in progress and finished goods. WIP, work in progress and finished goods. Now, what is raw material ka valuation? You must have heard this. Stock should be valued at cost price or market price, whichever is lower. I'm 10,000% sure you must have heard this. Stock should be valued at cost price or market price, whichever is lower. Now charted. Fair enough. Raw material should also be valued at cost price or market price, whichever is lower. But what does it state? Raw material should always be valued at cost. If market price of finished goods falls below the cost of the finished goods, then raw materials should be valued at replacement cost. First, let us write this down. A. Raw material should be valued at cost, but if market price of finished goods is less than cost of finished goods, then raw materials should be valued at replacement cost. Raw material should be valued at replacement cost. Now, there are two doubts in your mind. What does this sentence mean and what is replacement cost? First, we'll understand the sentence and then we'll understand the meaning of replacement cost. Listen to this example, listen to this sentence very carefully. If price of the finished goods falls below the cost of the finished goods, then raw material should be valued at replacement cost. That means what I'm trying to say. I am trying to say if the price of the shirt falls below if the market price of the shirt falls below the cost of the shirt, then cloth should be valued at replacement cost. If the market price of shirt, that is finished goods, falls below the cost of the shirts, that is finished goods, then raw material, that is cloth, should be valued at replacement cost. If the price of the calculator chartered, if the price of the calculator, market price of the calculator falls below the cost of the calculator, then plastic used in this calculator, that is raw material, should be valued at replacement cost. If values of shoes, market price of shoes falls below the cost of the shoes chartered, if market price of the shoes falls below the cost of the shoes, then leather should be valued at replacement cost. If market price of the table, falls below the cost of the table, then wood should be valued at replacement cost, that is raw material chartered. Am I clear? Understood? Yes. Sir, but what is replacement cost? Now understand. Closing stock should be valued at cost price or market price, whichever is lower. What does market price means? Price of buying the goods is market price or price of selling the goods is market price? Sir, both? No. Finished goods ka market price, finished goods we buy or sell. Sir, sell. That means when I say stock should be valued at cost price or market price, whichever is lower, and if I am talking about finished goods, then I should be talking about market price of selling, because finished goods we sell. But when I say stock should be valued at cost or market price, whichever is lower, and I am talking about raw material, then raw material we buy or we sell? Sir, we buy. Then market price should mean market price of buying or market price of selling? Market price of buying. That means Now look at raw material. Raw material should be valued at cost price or market price of buying, whichever is lower. I repeat, raw material should be valued at cost price or market price of buying, whichever is lower. Closing stock of finished goods should be valued at cost price or market price of selling, whichever is lower. Raw material, cost price or market price of buying, whichever is lower. Finished goods, cost price or market price of selling, whichever is lower. Market price of buying is known as replacement cost. So there are two types of market price: market price of buying, market price of selling. Market price of buying is known as replacement cost. So chartered, market price of buying is known as replacement cost. Market price of selling is known as net realizable value. Am I clear, chartered? Yes or no? Yes, sir. Now, why like this? Obviously, if the price of the calculator will fall, that means by default, price of plastic will also fall. I cannot say market price is lower. So cost price was 100, market price is 80. So this should be valued at 80. Then raw material included in this should also reduce. Correct? Yes. That's why if finished goods decreases, then raw material price also has gone down in the market. Am I clear? Yes or no? So chartered, if market price of finished goods falls below the cost of the finished goods, then raw material should be valued at replacement cost. Replacement cost means market price of buying. Market price of selling is known as NRV. Now, work in progress and finished goods. Work in progress and finished goods. A should be valued at cost or NRV. Cost or NRV, whichever is lower. Correct? Item by item basis. Example. Cost NRV. A 100, 120. 100 will take. B 100. 60. Correct? 160 will take 60. B 100, 100. So you'll take 100. Correct? Total is this how much? 300. Total is how much? 360. But this total is coming to how much? 260. We will not compare these two totals. We will not say cost is 300, NRV 360. So we will take 300 or 360, whichever is lower. Item by item. 100, 200, 100. B 100, 60, 60. C 100, 100, 100. Am I clear? Yes, sir. Now, chartered. Over here, there is two things. One, is cost, one is NRV. So let us understand the meaning of NRV. Let us understand the meaning of cost. NRV means net realizable value. That means value realized in hand after deducting all expected expenditure. Now, chartered, suppose this is a calculator which is unsold. Fair enough? Yes. Rather, to give you a better example, let me pick up this pen, chartered. Can you see this pen? This pen is without a cap. Correct? This pen with cap can be sold for 30 rupees. How much? 30. Therefore, can I say selling price is 30? Yes. But this pen presently is without cap. Can I sell this pen without cap? No. To sell the pen with cap and get 30 rupees, I have to put the cap. Yes or no? That cost of completing the product is 2 rupees. So in order to sell this pen at 30 rupees, how much expenditure I have to incur? Sir, 2 rupees. So if I incur 2 rupees expenditure, how much will I get? 30. So ultimately, how much I got? 2 I spent, 30 I got. How much I got? Net is 28. Now this pen, I cannot sell it like this. I put it in a wrapper, fold it up, put a string, and then sell it. When I put it in a wrapper, put a string, and then sell it, that packaging or selling cost is 1 rupees 50 paisa. That means in order to sell the pen, first I have to complete its cost. Fair enough. How much is the cost of completion? 2 rupees. Thereafter, expected selling expenditure, how much? Expected selling expenditure chartered. Expected selling expenditure is how much? 1 rupee 50 paisa. If expected selling expenditure is 1 rupee 50 paisa, then net realizable value is how much? 30 I will get. 2 rupees cost of completion, 1 rupee expected sell, 1 rupee 50 paisa expected selling expenditure. That means total expenditure is 3 rupees 50 paisa. Ultimately, I'll get how much? 26 rupees 50 paisa. That is net realizable value. So I can say net realizable value is nothing but estimated selling price less estimated cost of completion, that is 2 rupees, less estimated selling expenses. Sir, sir, why are you writing estimated? Because this is an unsold stock whose market price, has fallen below the cost. So I believe when I sell, it will be sold at 30 rupees. But in order to sell at 30 rupees, I have to in future incur 2 rupees and 1 rupee 50 paisa for packing. So that is all futuristic income and expenditure. So all are estimated. Whatever you get is known as NRV. Am I clear, chartered? Yes, sir. Thereafter, cost chartered. Cost means in cost, we have got 3 methods chartered. First is standard cost. Second is retail price or adjusted selling price method. And the third is actual cost. Now, chartered basically as a chartered accountant, it's not our domain or our area to find out the cost of production or cost of manufacturing this calculator chartered. Reason being, for this, there's a specialized cost which is known as cost accountant. So if in any factor there's a cost accountant, whatever cost he gives us, that is the standard cost. Am I clear? We don't apply any brains. Whatever cost the cost accountant gives us, that is a cost, and that is known as standard cost. So I can say cost as per cost accountant. He finds out the actual cost and tells us that this is the cost, and we say fair enough, this is the cost. Over and out. Now, retail price or adjusted selling price method. That is, if the goods are sold at fixed MRP with selling price, fixed MRP plus fixed GP percentage, then whatever is the closing stock left at MRP or selling price minus GP percent will give me closing stock at cost price. I repeat, this method is applicable if there is fixed selling price and fixed GP percent. First thing, this method is applicable if there is fixed selling price and fixed GP percent. If closing stock is at selling price minus the GP percent, we'll get closing stock at cost price. Fair enough. So over here, can I say it is closing stock at selling price minus GP percent? Closing stock at selling price minus GP percent? Yes, sir. Now charted. Actual cost. This is the last option. First option, cost accountant. Second option, retail price. Third option, when we cannot, when there is no cost accountant, there is no fixed selling price, there is no fixed GP percent, then we are supposed to find out actual price of finished goods. How do we calculate the cost? That is purchase cost less trade discount, add taxes, add conversion cost. Correct? Fair enough? Yes, no. Yes, sir. Purchase cost, if you are a trader, that means we are dealing in finished goods, then purchase cost represents purchase cost of finished goods. If you are manufacturer, then purchase cost represents purchase cost of raw materials. It can be raw material or finished goods, as the case may be charted. Less trade discount, add taxes, add cost of conversion, that is labor cost, then indirect material cost, factory overheads, production overhead, all those. Now, conversion cost charted. Conversion cost does not include a admin expense, storage expense, any abnormal loss of goods, any finance or interest cost. Storage expense means go down expenses. Am I clear? So I hope chartered you understood the meaning of NRV and the cost. Cost can be calculated. First, you take the cost from home, cost accounting. Cost accountant not there, then selling price minus GP percent. But if there is no fixed selling price and no fixed GP percentage, then what do? We calculate the actual cost. Purchase cost less trade discount, add non-refundable taxes. Correct? add cost of conversion, and cost of conversion does not include this. Now, charter. Let's do an example on retail price. Now, purchase cost 2 lakh. I hope you are writing. Trade discount 10%. Taxes 5%. Packaging 21,000. Sales 2,70,000. Closing stock at selling price 30,000. What do you mean by closing stock at selling price? If closing stock was sold, it would have been sold at 30,000. If closing stock was sold, it would have been sold for 30,000. Can you tell me if closing stock was sold, then what would have been total sales? So 3 lakhs. How? 2,70,000 is actual sales. Yes. Closing stock, if that would have been sold, that would have been sold for 30,000. So if closing stock was also sold, total sales would have been 270 plus 30. 270 is given in the question. Am I clear? Yes or no? Yes, sir. Now, charted. Step 1. Purchase cost or cost of purchases. Correct? Now, that is two lakh. Then trade discount 10%, that is 20,000. Correct? So you get how much? 1,80,000. Then add taxes, that is 5% of 1,80,000. That is 9,000. So 1,89,000. Correct? Yes. Thereafter, packaging 21, that is 2,10,000. Fair enough? Now, so this is my purchases. Step 2 charted. Calculation of GP percent. Now charted, purchases is how much? 2,10,000. Purchases sold part is how much? Sold at selling price 270. Unsold at selling price 30. That means if entire purchase was sold, it would have been sold for how much? 3 lakh. If entire purchases was sold, it would have been sold for how much? 3 lakh. 2,10,000 is the cost. Correct? 2,10,000 is the total cost of purchases, out of which certain part is sold, certain is unsold. The sold is at selling price of 270. Unsold is at a selling price of 30. That means if entire purchases were sold, they would have been sold at 3 lakhs. If entire purchases were sold, they would have been sold at 3 lakh. GP then would have been 90,000. GP percentage is equal to GP by 3 lakhs into 100, that is 30%. Now, is this my actual GP percent? Yes. But is 90,000 my actual GP? No, my actual GP will be what? 2,70,000 into 30%, that is 81,000. I repeat, is 30% my actual GP? Yes. If entire goods were sold, I would have earned 90. If entire goods were sold, I would have earned 90. But I have sold only 2,70,000. So on 270, I would have earned how much? 270 into 30%, that is 81,000. Am I clear? Yes, sir. So is 90,000 my actual GP? No. My actual GP is 81,000. That is 2,70,000 into 30%, that is 81,000. But I am not interested in my actual GP. I am interested in actual GP percentage, which is 30%. Okay. Step 3. Closing stock at cost. Closing stock at cost. That is chartered. Closing stock at selling price minus GP percent. 30,000 is that selling price. Closing stock at selling price is how much? 30,000. Where? Given in the question. Minus GP percent, 30%. 21,000. That means closing stock, if it is sold, it would have been sold at 30,000. What is its cost? 21,000. Okay. There is another way also. Or selling price, cost price. Total cost of purchases is how much? 2,10,000. Total cost of purchases is 2,10,000, which we calculated in step 1. If entire purchase was sold, it would have been sold at how much? 3 lakh. If entire purchases was sold, it would have been sold at 3 lakhs. Yes. Closing stock at selling price is how much? 30,000. So if selling price is 3 lakhs, cost price is 2,10,000. If selling price is 30,000, what will be the cost price cross multiplication? 210 by 3 lakhs into 30,000. That is 21,000. Am I clear, chartered? Yes or no? Yes, sir. So chartered, we are done with principles of inventory valuation. Now we'll do techniques of inventory valuation, chartered. Now, Now chartered, when the goods are left, unsold goods are left, closing stock. There are two types of closing stock. Ordinarily, not ordinarily, interchangeable. Ordinarily interchangeable. That means closing stock which is left is so identical, is so very identical that now, like for example, I am a producer of this markers, this pens. In the entire year, I produce, I'm a dealer of this pens. In the entire year, I purchased 1,000 pens. How many pens? 1,000 pens in 5 lots. 200, 200, 200, 200. Correct? How many lots? 5 lots. Correct? How many pens I purchased? 1000 pens. In each lot I purchased how many pens? In each lot I purchased 200 pens. Now at the end of the year, 300 pens is my closing stock. Correct? If I have purchased in 5 lots chartered, that means there are 5 bills. Bill 1, bill 2, bill 3, bill 4, bill 5. 300 pens are left. These 300 pens are very similar to the 700 pens sold. Yes, no. Yes, sir. The items are ordinarily interchangeable, not ordinarily interchangeable. Same. So when the items are ordinarily interchangeable, then we use general identification method. That means this 300 pens are left from the first bill or the last bill or the average cost. Anything we can say? Yes. So over here we can use FIFO, first in, first out. That means 700 pens which are sold. They are sold from first lot 1, then they are sold from lot 2, then they are sold from lot 3, then they are sold from lot 4. So this 300 pens are left from last lot. Am I clear? Yes. Or we can apply LIFO, last in, first out. That means we are saying that we will sell goods from last lot first. That means the 300 last lot first. We have sold goods from last lot first. That means from 5th lot we have sold. Then we have sold from 4th lot. Then we have sold from 3rd lot. Then we have sold from 2nd lot. So the pens which are left from either the first lot or the 2nd lot. Am I clear? FIFO mein first in, first out. There were 5 lots. 1, 2, 3, 4, 5. So the 700 pens, I purchased 1000 pens. 700 pens are sold. 300 pens are left. I purchased them in 5 lots. Lot 1, 200. Lot 2, 300. Sorry. Each 5 lots, each lot of 200. When I say I am following FIFO basis, that means I am first selling from lot 1. Then I am selling from lot 2. Then I am selling from lot 3. Then I am selling from lot 4. That means the goods which are unsold, 300 units, are left from the last lot. Fair enough. 200 from the 5th lot and 100 from the 4th lot. Correct? Yes. If I say I am following LIFO, last in, first out, that means I have sold first pens from 5th lot. Then I sold it from 4th lot. Then I sold it from 3rd lot. Then I sold it from 2nd lot. That means pens which are left from the first lot full and 2nd lot half, because 300 pens are left. First lot full, 200. 2nd lot is of also 200, but only 100 is left, because total my closing stock is how much? 300. I hope this you understood. I'll write it. How many lots were there? 5. Bill 1, bill 2, bill 3, bill 4, bill 5, 200, 200, 200, 200, 200. Correct? I can assume FIFO. That means first in, first out. Sold, sold, sold. 100 is sold, 100 is left. So my closing stock is this 300. If I am following LIFO, last in, first out. Last in, first out. Sold, sold, sold. 100 sold, 100 left. Therefore, my closing stock is this 300. Correct? Or I can follow average. That 300 is left at an average price. Am I clear? Yes, sir. This is known as general identification method. Average mate is weighted average method or simple average method. Am I clear? Weighted average method or simple average method. Now chartered, accounting standard 2 allows only first in, first out and weighted average method. LIFO and simple average method are not allowed. Am I clear? But now chartered, if I knew that, then we apply over here specific identification method. That means bill 1, bill 2, bill 3, bill 4, bill 5. I know this is sold, this is sold, this is sold, this is left, this is sold little, left little. So I know exactly from which bill it is sold, which bill it is left. Correct. This method is popular in case of antiques, where we know the antiques, if I'm doing the business of antiques, which antiques are unsold, I have the bill for them. I know this antique cost is this much only. Or in case of jewelry chartered. Am I clear? Yes, sir. Now, so this is your inventory valuation techniques chartered. Fifth is third is accounting for inventory. I'll speak about it. There are two methods. If you want, you can write it down or you can refer institute material also. Perpetual, periodic. Perpetual means continuous. In case of perpetual, there is a stock register maintained. There's a stock register maintained, there's a stock account maintained, which gives us information about continuous receipts and outflow of stock. But in periodic, there is no stock records maintained. At the end of the year, we physically go and count the stock. Am I clear? So perpetual mein, it is a continuous stock taking, records are maintained. Perpetual mein, there is no continuous stock taking, records are not maintained. Fair enough. Second, since records are maintained, continuous stock taking is possible over there. In periodic, continuous stock taking is not possible. Correct. Perpetual mein, every transaction of inflow and outflow of goods is recorded. Periodic mein, inflow of outflow of goods are not recorded. You can refer ICI for the answer, but whatever I'm saying, that is written. Either you can write it down fast or you can refer. Listen to me, understand and refer it from the institute material or JKSC material, wherever it is necessary. Continuous stock taking, no continuous stock taking. Stock register is maintained, stock register is not maintained. Every transaction is maintained, every transaction is not maintained. In perpetual, any loss can be found out, can be ascertained. In case of periodic, loss cannot be found out. It is just the difference we say is a loss. Correct? Since records are maintained and continuous stock taking is done, that's why it is a little expensive method over here. There is just a physical count of the stock at the end of the year. There is just a physical count of the stock at the end of the year. That means no records are maintained. So it is an inexpensive method. Am I clear, chartered? Now, last is over here. Stock reconciliation or stock finding. There are two types of stock. There are two types of stock chartered. One is known as physical stock, one is known as financial stock. What is the difference between physical stock and financial stock? And financial stock. This is book value. This is known as book value. I repeat, if you want, you can write it down, chartered. Physical value of the stock is the value of stock which is physically present in my godown. Physical value of stock is that stock which is physically there in my godown. Correct? Financial stock is that stock which I own, which may be there in my godown, may not be there in my godown. Financial stock is that stock which I own, which may be there in my godown, may not be there in my godown. For example, goods at branch, I own. Is it there in my godown? No, but my stock, financial. Goods, unsold stock with consignee. Unsold stock with consignee chartered. Is it there in my godown? No. Is it there in consignee's godown? Yes. Is it my stock? Yes. Sale on approval. Goods are with customer. Don't you think it is my goods? Yes. That means stock with branch, stock with consignee, stock on sale on approval. All these goods I own, but they are not my stock. So financial stock means stock which is owned, which may be there in my godown, may not be there in my godown. Physical stock means that goods which are physically there in my godown. Am I clear? Now chartered. Remember this notes. What are these notes? First, if goods are purchased before 31st of March, but received after 31st of March, then it should be included in now goods are received before 31st of March, but bill is received after 31st of March, then it should be included both in physical stock and financial stock. If the goods are received, obviously it will come in my physical stock. But even if the bill is not received, still you will include in financial stock. Why? Because this is as per accounting standard 4 and accounting standard 9. Let's not get into that much of detail, but remember this. Am I clear? This is note 1. Note 2. It would be always given in the question physical stock and calculate either physical stock or financial stock. Am I clear, chartered? Yes. Always ask 2 questions. Is it there? Your answer can be yes. Your answer can be no. Should it be there? The answer can be no. The answer can be yes. Is it there? Yes. Should it be there? No. Then you will subtract. Is it there? No. Should it be there? Yes. Is it there in your godown? No. But it should be there. Yes, it should be there. Then you will add. If both are yes, or if both are no, then you will not do any treatment. Am I clear, chartered? Yes. Shall we move ahead? Yes. Let's do one question, chartered. On the stock taking, LIFO FIFO is very simple. Inventories, page number 6, question number 5. Solution to page number 6, question number 5. Let's read this question. Closing stock is valued by XYZ stores on generally accepted accounting principles. Stock taking for the year ended 31st of March 2017 was completed by 10th of April 2017. Fair enough. The valuation of which showed a stock taking for the year ending 31st of March 2017 was completed on 10th of April 2017. Correct? This is 31st of March 17. This is 10th of April 17. On this date, physical stock was how much? 1,67,500. We are moving from year to year. Remember this arrow very nicely because we are supposed to calculate book value of stock as on 31st of March. Now, shall we start? Yes. After the end of the accounting year and till the date of completion of stock taking, that is 10th of April, sales were made for 6,875. Sales 6,875. Profit margin being 33.33% on cost. 33.33% on cost is equal to 1/3 on cost, 1/4 on sales. So profit 1/4 or 25% charted, that comes to 6,875 divided by 4. 1719. 1719. Profit, therefore, cost is how much? Cost is 6,875 minus 1719. 5156. Now charted. If I sold the goods after 31st of March, that means on 31st of March, it should be there, it should not be there. Sir, it should be there. Obviously, if it was there on 31st of March, I would have sold it after 31st of March. Correct? No, because if I did not have the stock on 31st of March, how can I sell it after 31st of March? Barobar? So I had something on 31st of March, and after 31st of March, I sold it. If I sold it after 31st of March, will those goods be there with me on 10th of April? No. So I'm moving from yes to no, no to yes. Sir, you are moving from no to yes. No to yes, charted. No to yes, you will add or subtract. No to yes, you will add. That means stock on 10th April 2017, 167,500. Add cost of goods sold, COGS, 5156. 5156. Correct? Yes. Thereafter, purchases for the next year included in the stock amounted to 9,000 at cost less 10% discount. So over here, purchases during this period was 9,000 minus 10% discount, that comes to 8,100. Purchases for the next year means after 31st of March included in the stock amounted to 9,000. If I purchase anything, I am standing on 31st of March. If I purchase anything after 31st of March, will it be there as on 31st of March? No. I purchased a phone. I purchased a phone on 2nd of April. I purchased a phone on 2nd of April. Was that phone with me on 31st of March? Obviously not. So if I purchase anything after 31st of March, it was not there with me on 31st of March. Correct? And if I had purchased it before 10th of April, obviously it was there with me on 10th of April. Yes or no? If I purchase anything yesterday, it will be there with me today. If I purchase anything before 10th of April, it will be there with me on 10th of April. So I am moving from no to yes to no. Less purchases. How much? 8100. Correct thereafter. During this period, goods were added to the markup of rupees 300 in respect of sales return. Sales return 300 minus 1/4 of 300. Sir, why 1/4 of 300? Because gross profit is 1/4 of sales. Yes. Correct. If the goods are returned after 31st of March, it was there with me on 31st of March? No. If the goods were returned after 31st of March, it was not there with me on 31st of March. It was there with me on 10th of April. Yes to no, less. Correct. So over here it will become less cost of sales return. How much? 225. Thereafter charted. After stock taking, it was found that there were certain very old, slow-moving items costing rupees 1125 should have been taken at 525. I have taken at how much? 1125, but I should have taken at only 525. That means I have to decrease my stock, revalue of stock by 600. You have to decrease because its cost is how much? 1125. NRV is how much? 525. That means I have to decrease by how much? 600. Similarly, due to heavy flood, certain goods costing rupees 1550 received. So cost is 1550. I received from my supplier. Received from the supplier beyond the delivery date, because suppose he was supposed to give me on X date, he gave me after that. Beyond delivery date, he gave me after that. What is the cost? 1550. Because he gave me beyond delivery date, I could not give it to my customer. It is given. As a result of the customer refused to take the delivery. So the cost was how much? 1550. Because he gave me late, my customer did not give. So it is there with me only. I should value at cost 1550. But its NRV is how much? 1250. I have valued at how much? 1550. NRV 1250. So I have to reduce by how much? 300. 1550 minus 1250. Less revaluation. Stock 300 charted, you can calculate and find out the answer. Am I clear? Yes or no? Yes, sir. That is 167,500 plus 5156 minus 8100 plus 225 minus 600 minus 300. One 67,500 plus 5156 minus 8100 minus 220. Sorry, 167,500 plus 5156 minus 8100 plus 225 minus 600 minus 300. 163,881. You can please check the calculation, but all the entries are correct. Am I clear? So I purchased, last one I am repeating again. I purchased for 1550 to give it to my customer. Customer did not accept to take it because date has gone. This 1550 I included in my stock. Then I found out its NRV is 1250. Its NRV is 1250. So I have to decrease it by 300 charted. Am I clear? So that's all for your inventory charted. We take a fast 5-minute break and we meet after break for average due date charted. Am I clear? Please revise your inventory and then we start with the break after 5 minutes break for inventory valuation charted. Hello, Chartered. Welcome back. Let's start with a new chapter. It's a very simple mathematical chapter, which is known as average due date. So first, let us understand what is average due date. Short form is ADD. Now, average. What is average, Chartered? Mean value, the middlemost value, which represents the average or mean of the middlemost value of a class. Correct? Due date. Due date can be date of payment or date of receipt. So average date of payment or average date of receipt is known as average due date. Now I'll give you an example. I was supposed to pay my friend on 1st of January 10,000. I was supposed to pay him on 31st of January another 10,000. So 1st of January 10,000, 31st of January 10,000. I told him that I will give you entire 20,000 on 16th January. He said, no. Right? First 10,000 on 1st of January, another 10,000 on 15th of 31st of January, one 10,000 on 1st of January, another 10,000 on 31st of January. Instead of that, I am ready to pay him entire 20,000 on 16th of January. He told, no. I told him, Ari, first 10,000 you will get 15 days late, but another 10,000 you will get 15 days earlier. That means, Chartered, if I make entire payment of 20,000 on 16th of January, on first 10,000 he will lose interest on 15 days, and on another 10,000 he will gain interest of 15 days. Therefore, Chartered, there will be no loss of interest to either of the parties. Both the parties will not lose any interest. Therefore, can I say average due date is nothing but if you are supposed to make several payments to one person, if you are supposed to make several payments to one person on several dates, instead of that, you make all the payments on one single day, entire payment on one single day, without involving loss of interest to either of the parties, then such an equated date of payment is average due date. Fair enough? So what is the meaning of average? Middlemost value of the class. What is due date? The date of payment or date of receipt. If you are supposed to make, what is average due date in totality now? If you are supposed to make several payments to one individual on several dates, but instead of that, you make the entire payment on one single date without involving loss of interest to either of the parties, then such a date of payment, then such an equated date of payment is known as average due date. Am I clear? Yes. Now, Chartered, how does average due date help? Suppose I am to make payment on 4 different dates. Understand this very carefully. And I decide upon a date which is year. Can I make all the payments over year now? No. Why? Because these 2 transactions are yet to come. I calculate average due date maybe after all the 4 transactions are over. So I was supposed to make the payment over year. Now, if I make the payment on average due date, there is no loss of interest. If I make the payment before average due date, then there is savings of interest. If I make the payment after average due date, then I have to give the interest. So average due date basically helps us to calculate interest, Chartered. If you make the payment on average due date, no loss of interest. If you make the payment before average due date, then savings of interest. And if you make the payment after average due date, then you are supposed to pay interest, Chartered. Now let us see how does it work. Let us write down some notes. So let's write down. Now, so average due date, meaning you understood that I'm not writing. So what is average due date? You understood. Now, chartered. How to calculate due date? You listen to this. There are two types of transaction. Without bills of exchange, with bills of exchange. Without bills of exchange, may without period, with period. Without credit period, with credit period. If it is without credit period, then date of transaction is equal to due date. The date of purchase or date of sale is the due date if there is no credit period. If it is with credit period, then due date is equal to date of transaction plus period. Correct? If it is with bills of exchange, then due date is equal to date of drawing, which we studied in bills of exchange, date of drawing plus period plus 3 days of grace. Correct? If after site is mentioned instead of date of drawing, after site, then date of acceptance. If due date falls on any public holiday, 15th of August, 26th of January, any Sunday, 1st May, 2nd October, then we take 30th September, 1st of April, then we take the previous day. If it is not a public holiday, if it is a sudden holiday because of, any riot or any strike or any lockout, then one day after. So if the due date falls on a public holiday, one day before. If the due date falls on a sudden holiday, then one day after. Am I clear? Now, suppose chartered, a due date comes on 15th of August. So it's a public holiday, so you will take 14th of August. And now 14th of August is a sudden holiday. Then what you do? 16th of August. Am I clear? Yes, no. Yes, sir. Another way. Suppose your due date comes on 14th of August. First example. Your due date came on 15th of August. So one day before. 14th of August. If 14th of August becomes a sudden holiday, then 16th of August. Another way. If your due date was 14th of August. Correct? So you're supposed to pay on 14th of August only. 14th of August is a sudden holiday. So you'll go on 15th of August. Now 15th of August is also a public holiday. Then you'll again go to 16th of August only. Am I clear? So if it falls on a sudden holiday, then you go to the next day. Next day is a public holiday. Then you go to the next day. Am I clear? Yes, no. Yes, sir. Now, so this was as far as due dates are concerned. Now, how to calculate average due date? Very simple. Very, very simple. Now, first of all, suppose average due date is there are several dates of payment. 1st of March, 1st of April, 15th of June, and 31st of July. So these are the several dates when you're supposed to make the payment? Yes. Now, suppose your ADD comes on, say, suppose 15th of May. On 15th of May chartered, and you calculated ADD after 31st of July. You calculated ADD after 31st of July. So obviously 15th of May is gone. Now, if you make the payment, therefore definitely you will make the payment after 15th of May. So you will calculate interest from average due date to the date of payment. So average due date ko if you pay, no interest. Before average due date, if you pay, you save interest. After average due date, if you pay, then you have to charge interest. But suppose you calculated average due date before 31st of March, before 1st of March only, because you knew all the due dates. You calculated average due date before 1st of March because you knew all the date of payment. And you made the payment, entire payment on 15th of May. No problem, no interest. If you made the payment before average due date, then you will save interest. If you made the payment after average due date, then you will pay interest. Simple. Yes. Now the most important doubt is how to calculate average due date. Due date. Correct. Amount. Days. Product. Product is equal to amount into days. What is date? Base date to due date. And due date, it may be given or it needs to be calculated. Sometimes students ask me, sir, how do we come to know whether the question is of bills of exchange or not of bills of exchange? If the question is of bills of exchange, it will be very clearly stated the following bills were drawn or accepted. If the question is not of bills of exchange, it will be clearly stated the following purchase or sales were made or the following payments were to be made on the following due dates. If bills are there, they will specifically mention the following bills were drawn or accepted. That means it is with bills. If the question states the following purchase or sales are made, then there is no bills. The following payments are to be made, then there is no bills. Am I clear? Yes, sir. Days is equal to base date to due date. Now, obviously, what is base date? You remember when you did statistics and you calculated mean, you had one formula, A x bar is equal to A plus summation FD by summation F. Correct? A was assumed mean. Yes. Assumed mean can be any number. Yes. But generally it should be middlemost number. Yes. And D is equal to X minus A. Yes. Same thing over here. A means assumed mean. Over here, A means assumed due date. That assumed due date is base date, which is generally earliest due date. We can take any due date, but this is safe bet. Like the middlemost number is a safe bet. You can take any number on earth, but middlemost number is a safe bet. Similarly, you can take any date on earth, but middlemost earliest due date is a base date. That is nothing but your A. Base date to due date is nothing but your D, which is represented as days. Then FD is nothing but frequency into days. Over here, product is nothing but amount into days. Then average due date is equal to base date plus total of product by total of amount. So it has been derived from this formula only, chatted. This formula. Now, then it will become base date plus dash days. If this dash days comes in point, always take the next whole number, because 10.1 day, that means 10 days are over, it is 11th day. It is not money. And this is applicable only in case of days. In case of money, 10.1 is equal to 10, 10.5 is equal to 11, 10.6 is equal to 11. But in case of days, all is 11 only, because 10.1 also falls on 11th day. Am I clear? So in case of money, 0.5 and above, next. Below 0.5, previous, in case of money. But in case of days, any fraction, next day. Correct? Yes, sir. Now, chartered. So let's solve one Question on average due date? No. Thereafter, interest. If payment is on ADD, no interest. If payment is before ADD, interest is saved. Interest is saved from DOP to ADD. So what is DOP? Date of payment. What is DOP? Date of payment. If you make the payment before ADD, then you will save interest. For what period? Date of payment to average due date. After ADD. And interest charged from ADD to date of payment. ADD before, then date of payment to average due date. After, then ADD to date of payment. Correct? So remember this, you save interest, you charge interest from date of payment to ADD or from ADD to date of payment. Correct charted? Yes. Now, question number 2 charted. Question number 2, page number 4. Kiran had following bills payable. Kiran had accepted bills payable. It is given very clearly. It's a bill wala question. The question is related to bills. Kiran had accepted bills payable to Hina. That means Kiran was supposed to make the payment. Kiran had accepted. So it is bills payable for Kiran. Kiran is supposed to make payment. To whom? Hina. Falling due on different dates. The details of bills are given below. Date of bill, amount, issuance of bill for 4 months, 3 months, 6 months, 3 months. Now, generally bill cannot be for more than 3 months. But if it is given in the question 4 months and 6 months, we'll not argue with the question. We'll solve accordingly. Generally, as per Negotiable Instrument Act, a bill can be valid only for 3 months. That is 90 days. But if the question says 4 months and 6 months, will we argue? No. Date of bill, amount, issuance. On 1st July, it was agreed that these bills should be withdrawn and that Kiran should accept on that day 2 bills. One for rupees 10,000 due in 4 months and other for the balance with interest due in 6 months. Now charted. First, let us calculate average due date without any hiccups. So, calculation of average due date. First column is due date. 9th of April plus 4 months. 9th of April, that means 9/4. 9/4 plus 4 months is 9/8. 9th of April plus 4 months. 9/4 plus 4 months, 3 days is equal to 12th of April. Am I clear? Yes. This I have written for the first time. Next I will not write. So directly I am writing 12th of April. Correct? Yes. 18th of April. For how many months? 3 months, 3 days. That becomes 21/7. Thereafter charted it is 25th May. For how many months? 6 months. And 3 days of grace. So 28/11. Correct. Thereafter 5th of June for 3 months and 3 days of grace. 8th of September. Correct? Yes. So we've got all the due dates with grace days. Now charted. Amount. Amount given in the question is how much? 3,000, 5,500, 3,000, 6,000, 8, 10, 9. So total is 17,500. Correct charted? Yes, sir. Thereafter. Which will be the base date? Earliest. The first one is 12/8. First due date is 12th of August. How it was? 9th of April plus 4 months and 3 days. So it was 12th of August. Correct? Which is the earliest due date? 21st of July. So this is our base date charted. Yes? No. Yes, sir. Now. Thereafter, days is equal to 21st July to due date. That is 7th, 21st of July to 12th of August. 21st of July to 12th of August. So how many months are there in 10 days are left in July? 10 days are left in July. Yes or no? Because July has how many days? 31. How many are gone? 21. So how many are left in July? 10. I repeat. 21st July to 12th of August. July how many days? 10. And August how many days? 12. So 10 plus 12 is how many days? 22 days. Thereafter 21st of July to 21st of July is 0 days. Then 21st of July to 28th of November. How many days of July? 10. August 31. September 30. October 31. And this 28. July 10. August 31. September 30. October 31. And 28 days of November. So 10 plus 31 plus 30 plus 31 plus 28, 130 days. Then 21st of July to 8th of September. July how many days? 10. August 31. September 8. July got 10 days left because total 31 days of July are there. 21 are gone. So you're left with 10 days of July. Full of August 31 and 8 days of September. So 10 plus 31 plus 8 is equal to 1 minute. $49. Correct? Yes, no. Yes, sir. No. So we are done with days. Now charted product. First is $3,000. 3,000 into 22. 66. Then 0. Then 3,000 into 30. 3,90,000. Then 6,000 into 49. Total 3,90,000 plus. Correct? Yes, sir. Now, ADD is equal to base date 21st July plus 7,50,000 divided by 17,500 plus 42.8 days it is coming, so I'm taking 43 days. Correct? Now charted, I have to calculate 21st July plus 43 days. If you look over here charted, if you look over here, then July plus 49 days is 8th of September. Correct? Incorrect? Yes. But you are not supposed to add, if you add 49 days, you'll get 8th of September. If you add 43 days, that means 6 days less. Then it will become 6 days less. 8, 9 minus 6 days will become how much? 2nd September. Or you can see 21/7 plus 10 days. July is over, but we are left with how many days? 33. Then August ka 31. You had how many days? 43. If you subtract 10, July is over. 43 August, 31 days. August is over. You're left with how many days? 2 days of which date? September. Okay. Now don't again add grace days. Don't try to check also whether this is a Sunday or not a Sunday. Am I clear? Now, even if this is 15th of August, no problem. Oh, if this is 15th of August, falls on a public holiday, no problem. Okay, sir. So you can calculate 21/7 plus 43 days in 2 days. How did I calculate first time? I said, if you add 49 days, you get 8, 9. Can you see? But I'm supposed to add only 43 days. That is 6 days less. Therefore, 8, 9 minus 6 days is 2, 9. Or 21/7. You had 43 days. You add 10, August is over. Then you add 10, July is over. You add 31, August is over. You're left with 2. You add 2, you reach 2nd of September. Correct? Yes, sir. So 2nd of September is the average due date. If you make the payment on 2nd of September, there is no loss of interest. Now, this 2nd of September is my average due date. Now let's read the question. The question states, on 1st July, it was agreed that these bills should be withdrawn. Okay. And that Kiran should accept on that day 2 bills, one for 10,000. So now calculation of due dates of new bills. Correct? First bill he is drawing on which date? First bill he is drawing on, both the bills he is drawing on 1st of July. 1st of July. This he is drawing for how many months? He is drawing for 4 months. That will become 4th of November 2018, and this is 6 months. So July, August, September, October, November, December. 6 months are over. 4th of plus 3 days of grace. 4th of January 2018. Sorry, 19. Because this comes in the next year. I hope this is clear. 1st of July plus 4 months and 3 days of grace. So this is 11 and this is 4. Correct? Yes. Then 1st of this plus 6 months. So this will become 13. That means January next year. 3 days of grace, 4th of January. Am I clear? 7 plus 6 is 13. 13 months are not there. 12 months of this year and 1 month of next year. So January and 4 days, 3 days of grace will make it 4th of January. Now chartered, he was supposed to make the payment on which date? Sir, 2nd of September. But he will make 10,000 ka payment on 4th. On this date, he will make rupees 10,000. And on this date, rupees 7,500. Plus interest. He was supposed to pay total 17,500. Can you see 17,500? I'm marking it. Yeah. He was supposed to make a payment of 17,500 on which date? 2nd of September. But out of that 10,000 he will make payment on 4th of November and remaining 7,500 on 4th of January. So let's calculate interest. So first, calculation of delayed days of payment from ADD. First bill. To 9/2018 to 4th November 2018. That is how many days? September ka 28 days are left. September's 28 days are left. Why? Because September mein total 30 days are there. First 2 days are gone. So 28 are left. October ka 31 plus November ka 4. So that will become 28 plus 31 plus 4. So first payment is delayed by 63 days. Correct? Yes. Second bill. 2/9/18 he was supposed to make the payment, but he will make the payment of remaining 7,500 on 4th of January 2019. Correct? Yes, no. So in the last line it is given the year 1819 and you are supposed to take 365 days. Correct? So September ka 28, October 31, November 30, December 31 plus January 4 is equal to So 28 plus 31 plus 30 plus 31 plus 4 is equal to 124 days. Correct, chartered? Yes, no, yes, sir. Now chartered. So these are the delayed dates. So first 10,000 he is making on, this is 10,000 wala bill. And this is 7,500, 7,500. Correct? So now calculation of interest chartered. How to calculate interest? Interest is 10,000, rate of interest is 10% into 63 by 365, 7,500 into 10% into 124 by 365, 10,000 into 10% into 63 by 365, 172.60. Then 7,500 into 10% into 124 divided by 365. That is 254.8. 254.8 plus 172.6. 427.4 is the total interest which you are supposed to calculate. So therefore, second bill is equal to 7,500 plus interest of 427.4 is equal to 7,927.4. Am I clear? Now chartered. So this is how you calculate average due date. Now chartered, in case of average due date, you can calculate interest on loan also. So what to do in case of interest on loan? Or first I can say there is amount payable and amount receivable. Then what do you do? Then you do you do it due date? You write amount payable, cross, cross, cross. And the amount receivable, you write negative. Am I clear? So this becomes your amount payable, this becomes your amount receivable. Correct? Then you follow the same system, days, one single base date, product. So you'll have positive, positive, negative, negative, negative. So total of this, and you can solve the question. If there is amount payable and receivable. Some of you might do amount payable separate, amount receivable separate, then say difference of amount payable, receivable, difference of product. It is same thing. No, we are doing difference only. But instead of preparing two tables, we can do it in one table. And if you, so you write amount pay, you give the heading of the column as amount payable, then all payable, receivables will become negative. That's it. One base date. And if you start with amount receivables, then amount receivables will be positive and amount payable will become negative chartered. Am I clear? Yes, sir. Thereafter, loan. First, base date is equal to date of loan taken. Correct? Due dates is equal to date of installment. Amount is equal to amount of installment. ADD as usual. Calculate ADD as usual. Correct? Now, ADD means date of repayment of entire loan. Date of repayment of entire loan chartered. Is that clear? Yes. Now chartered date of repayment of entire loan. Therefore, interest is equal to loan into rate of interest into date of loan taken to ADD, that is the total period, because ADD represents what? Date of repayment. If entire loan was repaid on one single day, it would have been ADD. If entire loan was repaid on one single day, it would have been ADD. Am I clear? Divided by 12 months or 365 days. So date of loan taken to date of repayment, you will calculate interest chartered. This if you are supposed to do questions of loan chartered. Am I clear? So I am very clear that your entire average due date, all concepts are done chartered. Revise this and then let's take a break for another 5 minutes and then we start account current chartered. We'll start account current chartered. Am I clear? Yes. So revise this, your entire average due date, and then we'll start account current. Now chartered, we are done with 2 chapters, another third simple chapter, that is account current. What is account current? Account current is nothing but an account of debtor or creditor or both. It's an account of a party. He can be debtor, he can be creditor, or we can purchase, sale, both we can do from that party. It is not an account of debtor or only of creditor. Am I clear? This account helps us to calculate interest also. This account helps us to calculate interest also. So account current is an account which shows receivables and payables and interest on net amount. Am I clear? Yes or no? Yes, sir. So let's not waste time and get into it. So chartered, let's start with the chapter called account current. It is an account of a party showing receivables and payables and calculation on net amount. Correct? Format. X in account current with Y. This means X's account in the books of Y. This means X's account in the books of Y means X's account books of Y. That means think and pass journal from Y's point of view. This is also known as account rendered by Y to X. Account rendered by Y to X. That means whoever is rendering account is preparing other party's account in his books. Am I clear? Yes, sir. Now chartered. This was the heading. Correct? Third. Format of account current. How do we prepare the format of account current? Date, particulars, due date, days interest or product, interest or product amount. So charted, this is debit side, one is credit side. Am I clear? Date, particulars, due date, days, interest or product, and amount. That means there are two ways of solving: interest method, product method. Am I clear? There are three methods of preparing account current. Point number 3. 4. Methods of calculating interest. There are two methods to calculate interest. One, interest on each transaction. That is interest method. That means for every transaction you will calculate interest. Then you will have interest column. Am I clear? Yes. Then charted. Interest on balance of product. Then we'll follow product method. There are two ways to calculate interest. Interest on each transaction, then interest method. Interest on balance of product or interest on product, then we'll follow product method. Now charted. That means if it is product, then we use product method. Maybe we'll have a product column. Product column is nothing but days into amount. Am I clear? Yes. There are three methods to prepare account current. Now charted, before going into methods. Number 5. Methods of account current. There are how many methods? 3 methods. Now charted, three methods. One is known as forward method. The other is known as backward method. And the last is known as periodic method. Correct? Now forward method में two ways, interest product. Backward में 2 ways, interest product. And periodic में 2 ways, interest and product. Periodic we follow only in bank passbook or current account of partners. which you would have done. There is one sum of Allahabad Bank. So let's not get into that. Now chartered. So logically, there can be 6 varieties: 2 in forward, 2 in backward, and 2 in periodic. Periodic method can be applied only if it is a bank passbook question or there is a current account question. Am I clear, partners? As in case of partnership. Now chartered, we are supposed to calculate interest. Now, understand this. There is a receipt, receivable, payable. There is a due date, there is a due date. Correct? Receivables ka due date, payable ka due date. How can we calculate interest? First method is due date to year end is total interest receivable. Due date to year end is total interest payable. So you'll get net interest. Correct? Due date to year end. Year end means period end or statement period, whatever you call it. So end date. Due date to end date, due date to end date. Subtract, you'll get net interest. So debit minus credit, you will get it because this receivables will be on the debit side, payables will be on the credit side. So basically, interest is calculated from receivables में due date to year end, total interest receivable, due date to year end, total interest payable, net interest. Okay. So this is one variety charted, and that is nothing but forward method. So in case of forward method, days is equal to due date to year end. You can call it year end, you call it period end, you call it statement end, any date. Basically, it is end date, or let me put it to end date. Correct? Now, due date to end date. Correct? Excluding due date. That means due date you will not consider. Opening balance, consider due date also. On opening balance, consider due date also. That means suppose you purchased on 1st of January. You purchased on 1st of January. If the due date of the transaction is 1st of January, then you will not include 1st of January. But if opening balance is on 1st of January, you will include 1st of January. Make this thing very clear. If the transaction is, if the due date of the transaction, purchase, sale, receipt, payment, anything, if the due date of the transaction is 1st of January, then you will not consider 1st of January. But if the due date of opening balance is 1st of January, then chartered, you will consider 1st of January also. That means one day will increase. Is this clear? Yes, sir. In backward method, days is equal to start date to due date. Now, first of all, let me make it one thing clear. How to calculate due date? The same way we did it in average due date or bills of exchange. If it is without bills, without credit period, without bills, without credit period, date of transaction is equal to due date. Without bills with credit period, then date of transaction plus credit period. With bills, then date of drawing plus period plus 3 days of grace. Am I clear? Yes, sir. So days is equal to start date to due date. Correct? including both days. It is start date as well as due date. Correct? Okay. Start date means period start date. Now, opening balance charted. Balance. Zero days. Over here, closing balance. 0 days. Correct? Closing balance is equal to start date to end date. Including correct. So we are talking about days. How to calculate days for transaction, for opening balance, for closing balance. Days. This is for transaction charted. This is for opening balance charted, and this is for closing balance charted. Let's not go into too much of logic behind it because we don't have time. Just remember this we are supposed to do, so it will become easy, and this chapter comes for maximum 4 marks. Now charted. Or you can still understand the fundamentals if you want. Like in the forward method, we are calculating from due date to year end. In backward method, what do we do? Start date, end date, due date. We calculate on closing balance full. Look at this very carefully. We calculate on closing balance full and minus this start date to due date. So we by default get due date to end date. So on closing balance, start date to end date full minus start date to due date. We remove. So by default, we get due date to end date. That is why it is called backward method. Full minus start date to due date. That's why we are taking start date to due date. Am I clear? And in this third, we take days as due date to next due date. Due date of the first transaction to due date of second transaction, then due date of second transaction to due date of third transaction, then due date of third transaction to due date of fourth transaction. So first one is start to end. First one is due date to end. Second one is start to due date. Third one is due date to due date. Am I clear? Yes, sir. Now charted. Remember, when I say closing balance, start date to end date. Start date to end date. Product. Rather, balance of product. Balance of product. What to do? Understand. Balance of product which you get. If you prepare a product column, there will be a balance of product column. Right on opposite side. Correct? Balance of product, right on same side. If balance of product comes on credit side, write on credit side. Over here, write on opposite side. That means if balance of product comes on credit side, write it on debit side. In case of forward method, balance of product will come on whichever side it comes. If balance of product column comes on the debit side, write it on the debit side. But in case of backward method, if balance of product comes on debit side, you're supposed to write it on the credit side. Interest on balance of product for 1 day. Interest on balance of product for 1 day. So balance of product into rate of interest into 1 by 365. Correct? This will come on opposite side of balance of product. This will come on opposite side of balance of product. Am I clear? So if balance of product logically comes on credit side, you will write it on the credit side, but interest will come on debit side. If balance of product comes on debit side, you will write it on debit side, interest will come on opposite side. Over here, on same side as of now, if balance of product is coming over here on credit side, you will write it on debit side. So interest will also come on same side. Okay, logically, if you see, both is happening same place. In the first, balance of product comes on credit side, then interest on debit side. In second case, balance of product on credit side, then you will write it on debit side. And interest also you will write it on debit side. So in both the cases, interest will come on debit side. Interest on balance of product for 1 day in amount column you will write. Correct? So I repeat. In the forward method, if balance of product comes on credit side, you will write on the credit side, interest will come on debit side. Correct? Balance of product on credit side, interest on debit side. In backward method, balance of product on credit side, you will write it on debit side, and interest will also come on the same side. Correct? Yes, sir. So this is, and again I repeat, there is forward interest and back. Forward may interest method, back product method. Backward may interest method, as well as backward may also interest method and product method. Same thing everywhere. Now chartered. So there are how many methods in total? In forward, 2 methods, interest product. In backward, 2 methods, interest product. In periodic, 2 methods, interest product. Correct? In backward method, closing balance, you'll calculate to start date to end date. So that will come in product column. But remember, one note. Under interest backward method, under interest backward method, calculate interest on closing balance from start date to end date and write in interest column. Sir, what is this? Now understand. Suppose started, this is the format which you are following. Fair enough. When you write balance carried down, closing balance, you'll write amount, and you will write its product. This I'm talking about backward method. This product, how did you calculate? This product is nothing but amount into days. I'm talking about backward method. How did you calculate days? Start date to end date. But chartered, if you are into days, that will get product divided by 365 into rate of interest. Then you will calculate interest. I repeat. In backward, there are two possibilities. Either you are following product method or you are following interest method. If you are following product method chartered, then closing balance ka product you will calculate. How will you calculate? Amount into days. How will you calculate days? Days is nothing but start date to end date. Finish. But, so this is product mein amount into days. And days is start date to end date. Correct? But in case of interest chartered, it is closing balance into days by 365 into rate of interest, because then you will not have product column, but if there is interest column, then you're supposed to calculate interest chartered on closing balance like this. Closing balance into days divided by 365 into rate of interest. That closing balance is very, very important. If it is product, then amount into days. If it is interest, then amount into days by 365 into rate of interest. Am I clear? Yes, sir. So backward method I have explained you fully. Correct? Now chartered. Let's solve the question on the forward method. Now, note this you have written. Under interest backward method, calculate interest on closing balance from start date to end date and write it in interest column. Is this clear? And then proceed as it is. Fair enough? Yes. So chartered. How many methods of calculation of interest are there? Two. Interest on each transaction and interest on product. Interest on product means balance of product into 1 by 365 into rate of interest. How many methods are there to calculate? Prepare account current? 3. Forward, backward. Forward mein due date to period end. Backward mein period start to due date. And this opening balance, closing balance is very important. Correct? There can be two methods. Product method and, like, let me write it. There are two methods over here. Product method, interest method, closing balance. Product column, what you will write? Amount into days. And over here, amount into days by 365 into rate of interest. Days is start date to end date. Is that clear? Now, another very important question. Nothing is mentioned. If nothing is mentioned, in the question, then A, calculate interest using product method. Am I clear? and B, use forward method. Use forward method. Simple chatted. So if nothing is mentioned about interest, product. If nothing is mentioned about method, forward. So if nothing is mentioned in the question, which things to follow? So you'll follow forward, product, method. Am I clear, chatted? Yes, sir. Now, let's look at question number 3, page number 4. The following are the transactions that took place between G and H during the period 1st of October, that is start date, to 31st of March end date. Am I clear? 1st of October start date to 31st of March end date. So October 1st, one minute chartered. Then October is missing. Then November, invoice dated 26th, December 7th, invoice dated 17th, 3rd January. And I'll give you the dates. 1 minute. And first is October 1, then second is October 17th. First date is 1st October, second date is October 17th, goods sold by G to H. Then November date is not mentioned, goods sold by G to H, invoice dated November 26. Invoice dated November 26. Please change. Invoice dated November 26. Then December 7, goods sold by H to G, invoice dated December 17th. Invoice dated December 17th. Correct? Then 2018. Promissory note given by G to H at 3 months. Promissory note given by G to H at 3 months. February 4th, then March 21st. March 21st. Goods sold by G to H. And March 28th, goods sold by H to G. In all the amount which you can see, it is 3,000, 2,500. So 1 0 is missing. Please add 1 0 everywhere. 3,000, 2,500, 4,000, 3,500, 5,000, 1,000, 4,300, and 2,700. Now charted, wait a minute. That is October. How many days are there? 31, 17 gone. So you are left with how many days? 14 plus November 30, December 31, January 31, February 28 plus March 31. Sorry, second date is not October 17, it is October 18. Second date is October 18th charted. Fair enough. And even if you have missed, when I am solving the question, I'll again repeat. Drop an account current up to 31st of March to be rendered by G. So who will prepare G in the books of G? We'll think from whose point of view? G's point of view. This is very important. We will think from G's point of view. To H, charging interest at 10% per annum. Interest is to be calculated to nearest rupee. Now they have not mentioned the method also. And they have not mentioned anything. So we'll follow product and forward method. So let's start. Solution to question number 3. Page number 4. The heading will be H in account with G. So we are supposed to think from whose point of view? G's point of view. date, particulars, due date, days, product, amount. And now chartered. Let's start. Now, from whose point of view are supposed to think? G's point of view. The first transaction of 2017, October 1st, balance due to G by H. Due to G by H. That means H has to pay G. H has to pay G. That means G is supposed to receive from H. If G is supposed to receive from H, it is receivable. Receivable means asset. Asset means opening balance on the debit side. So I'll write 1st October 2017 to balance brought down. Due date will be 1st October 2017 and amount will be 3,000. Balance due 2G by H. Due 2G by H. That means H has to pay G. G has to receive. We are thinking from whose point of view? We are thinking from G's point of view. That means G is supposed to receive. Receivable is asset. Asset has a debit balance. Correct? Charted? Yes. Thereafter. Next. October 18th. Goods sold by G. So G has sold. So if G is selling the goods, it is H to sales, H account debit to sales. Which date? 18/10/2017 to sales. Due date will be 18/10/2017. Amount is 2,500. 18th October, the printing is not there, only it is written October, so make it 18th October chartered. Am I clear? Yes, sir. Third, November, goods sold by H. So H has sold, G has purchased. So G will write purchases to H, purchases to H. H may buy purchases. Which date? It is, due date is November 26. 26/11/17. Buy purchases 26/11/2017. And amount is how much? 4,000. Correct? Yes. Then December 7th, goods sold by H to G. Again, goods sold by H to G. G has purchased. Date is 7th December 17. By purchase, and the due date is, invoice dated is December 17th. Invoice dated is missing. That is December 17th and previous was November 26th. Last transaction ka invoice dated is December 17th and 17th December and 17th December, and previous ka, as you can see, it is 26th November. Amount is how much? 3,500. So 2017 is over. 2018, 3rd January, promissory note given by G. Promissory note means G is saying I will pay. That is bills payable for G. So G is paying H. G will write H to bills payable. H to bills payable 3rd January 18. 3rd January 18. And that is for 3 months. It is 7/4/18. Correct? Yes, sir. Now chartered. And the amount of bills payable is how much? 5,000. I repeat that transaction. It is promissory note given by G. When I give promissory note, that means I promise to pay. It is bills payable for me. I am promising to pay H. So I will write H to bills payable. Am I clear? Yes, no, yes, sir. That is 5,000. Correct? Now, this date chartered is falling after the year end. 7/4. Correct. 7/4, ne? 3 months, 3 days it is. So 6/4. 6/4/18. 3 months. 3 months you cannot read. You add over there. 3rd January promissory note given by G to H at 3 months. 3 months is not printed. Print it. Correct? Yes. 4th of February, cash paid by G to H. Cash paid. Who paid cash? G paid cash. So what entry will G write? H to cash. What date? 4th February 18 to cash. 4th February 18. How much? 1,000. Goods sold by G. 21st of March. 21st March 18 to sales 21st March 18. How much it is? Goods sold by H, that is by purchases 28 March 18 by purchases. Invoice dated is 18th April. In the last transaction of 2018, in the last transaction of 2018 chartered, invoice dated is 18th April 2018. The amount is 2,700 chartered. Am I clear? No. The first thing is 31st of March 18. 3,000 plus 2,500 plus 5,000 plus 1,000 plus 4,300 minus 4,000 minus 3,500 minus 2,700. Correct. By balance, correct. Now, 5650 it is coming. Just I'm writing on a piece of paper. You need not write. Now chartered. I have to calculate days. How will I calculate days? This is forward method. Therefore, chartered, I can say I'm writing on the top days is equal to due date to end date. 1st October, including, that means October, how many days? 31. November 30. December 31. January 31. February 28. And March 31. So it is 182 days. Then 18th of October. 31 minus 18 is left with 13 plus November 30, December 31, January 31, February 28, March 31. 164. This is 6 days ahead. So this will become -6. This is 6 days ahead. After year end 6 days. So it will become -6 chartered. Am I clear? Yes, no. Yes, sir. No. This is not 18th April. This is 8th April chartered. Not 18th April. Where I'll put a green highlighter. Can you see? It is 8th April, not 18th April. Fair enough? Yes, sir. Thereafter, 1st of February. So 27 plus 31. 50. It is 4th of February. 4th of February. 24 plus 31. 55 days. This is 10 days. 26th of November. That is 4 days of November, 31 days of January, 31 days of, 4 days of November plus 31 days of December, 31 days of January plus 28 days of February plus 31 days of March. 125 days. 17th December, that means 14 days of December are left, 31 days of January, 28 days of February plus 31 days of March. Again, I am saying due date to end date excluding the due date. So 17th of December, December has 31 days, 17 gone, you're left with 14. So 14 days of December plus 31 days of January plus 28 days of February plus 31 days of March, 104. 8th of April, that is again 8 days ahead, so it will become -8. 8 days ahead. Correct. Now let's write down the product. Correct. Now let's write down the product. 182 into 3000. 182 into 3000 is how much? 5,46,000. Then 2,500 into 164. 4,10,000. Uh, 4,10,000. 3,000 into 546,000. Correct. Then negative 30,000, positive 55,000, 43,000, 125 into 5 lakhs. Then 104 into 3,500. This will become negative 2,700 into 8. Negative 21. 600. Now let me calculate balance of product. 546 plus 4 lakh 10 minus 30 plus 55 plus 43 minus 5 lakhs minus 364 plus 21,600. 1,81,600. So chartered, you will see 31st December. I am writing with blue pen. 31st December 2018 by balance of product 1,81,600. Is this clear? This is the balance of product. Where we are in the forward method, so balance of product will come in whichever side it comes. So this is the balance of product. Interest will come on the opposite side. So 31st of March 18 to interest. How will we calculate interest? 181,600 into rate of interest is 10% into 1 by 365, that comes to into 10% into divided by 365. 49.75. Let's round it off to nearest rupee because they have told. Otherwise, we would have taken 49.75. They have told round it off to the nearest rupee. So interest will come in the amount column, 50 rupees. Now balance will become 5650. Can you see red pencil last slide item on the amount column? Yeah. Correct, charted. So make whatever little bit of printing error is there, please look at the question and you can make the necessary changes, charted. But balance of product will come on the same side, interest will come on the opposite side. If this was backward method, balance of product would have come on opposite side, and interest, balance of product and interest will be on the same side. So if you ask me, what is the difference between forward and backward method? Forward mein product and interest is on opposite side, and product and interest is on same side. See over here, product charted is over here 181, but interest is over here. Balance of product mein this 181,600 would have come on the debit side. So that's all for your account current charted. So with that, we come to end of 3 chapters today as promised. Thank God there were no technical glitches from our side or from God's side also. It was wonderful being with you all. I hope you would have understood charted. Tomorrow we'll do BRS final accounts, and thereafter we'll be left with all major chapters only charted. Thank you so much. Please revise this very nicely, and I hope it works out for you. JK Shah sir has taken a lot of pains to organize this entire thing on a pandemic, to make teachers available, to arrange everything and put it in front of you on a complimentary basis. I hope you are taking full advantage of it, and hope to see you in early bird in Inters also. I am sure that you will give us chance to teach you early bird. Thank you so much. See you at 3:30 for your doubt session. Thank you so much, charters.